All right, let's dive right into this. If you've ever celebrated a major milestone, relaxed after a long week, or, just enjoyed a night out with friends, there's a very good chance you've contributed to the bottom line of the company we are analyzing today. Welcome to this explainer. We're looking at Diageo, the quiet, British-based corporate giant behind some of the most famous consumer brands in the world. As an equity analyst, I find the specific moment in their history absolutely fascinating because we are watching a massive, entrenched multinational empire try to navigate a very complex period of transition. So here is our roadmap for the analysis. We're going to start by sizing up their global spirits empire, then unpack the nuts and bolts of their mixed financial results for fiscal 2026. From there, we'll map out their geographic divides, and finally, break down the turnaround strategy management is banking on. Let's kick things off with part one, the global spirits empire. To really grasp the headwinds this company is facing, we first have to respect its immense cultural moat and sheer operational scale. Now, this number is staggering. $19.6 billion in reported net sales for fiscal 2026. Stop and just think about that scale for a second. Operating out of over 110 sites across 180 countries, Diageo is not just another beverage company, it's a titan. To put it in perspective, based on retail sales value, they are 1.8 times larger than their nearest international spirits competitor. They are operating at a level of logistical complexity and global dominance that very few consumer brands ever actually achieve. But how do you generate nearly $20 billion a year? Well, through what we might call the illusion of choice. When you browse the aisles of a liquor store, you see dozens of distinct brands, right? Unique histories, totally different marketing. But look closer. Guinness, Johnnie Walker, Smirnoff, Bailey's, Captain Morgan, Don Julio, Crown Royal, Casamigos. These vastly different cultural staples are all owned by the single corporate entity. That is a massive, durable competitive advantage. But here's where things get really interesting. When we break down that massive net sales figure by category, we see a heavy reliance on just a few core segments. Scotch makes up nearly a quarter of their business at 24%, obviously driven largely by Johnnie Walker. Beer, anchored by Guinness, brings in 18%. Then you've got tequila at 12% and vodka at 8%. The remaining 38% covers literally everything else. What does this mean for an investor? It means any shift in consumer preference, say a sudden dip in tequila or Scotch demand, has a disproportionately massive impact on the entire company's bottom line. They've got variety, sure, but they are heavily tethered to their flagships. Which brings us perfectly to our second section, a mixed financial year. Because despite that incredible size and market dominance, fiscal 2026 was honestly a pretty bumpy ride. Let's walk through the fundamentals here. Reported net sales were down 3% year over year to $19.64 billion. Operating profit took a much sharper hit, dropping 27% down to $3.15 billion. But, and this is a huge but if you follow value investing principles, look at the free cash flow. It actually increased by $463 million to hit $3.21 billion. How on earth do you pull that off when your sales and operating profits are tanking? Well, management stepped in with some serious financial prudence. They enforced strict operational discipline, specifically cutting capital expenditures, strategically investing in maturing stock, and lowering tax payments. So even as volume declined, the company's baseline cash generation remained incredibly robust and defensive. However, we all know Wall Street demands growth, and that is exactly where we hit a snag. Diageo experienced a 2.0% decline in organic net sales. When they announced their interim results reflecting this dip, it actually sent their shares tumbling 6%. I mean, for a massive defensive blue-chip stock, a 6% single-day drop is a major reaction. Let's pause for a quick second to define that metric because it's absolutely crucial. Organic net sales growth is essentially the true north of a company's top-line health. It completely strips away the external noise, things like foreign exchange fluctuations or a recent acquisition or sell-off. It shows us exactly how well the company is building brand equity, winning market share, and making the right pricing choices. So a 2% decline here means, plain and simple, fewer consumers were buying their core products compared to last year. And for a business historically built on relentless expansion, that is a glaring red flag. So, where exactly did they lose those consumers? Let's move to Section 3, Geographic Divides. To evaluate a global empire, we have to look at the global map. The global spirits market isn't just moving in one direction. Diageo actually found some great momentum in Europe, Latin America, the Caribbean, and Africa. But all of that growth was completely wiped out by severe headwinds in North America and the Asia-Pacific region. This is critical because North America is the financial engine of this entire operation. It accounts for nearly 40% of their total business. And in fiscal 2026, North American sales shrank by 6.8%. When your single biggest market contracts like that, it drags the entire global portfolio down with it. This chart brilliantly illustrates exactly what broke down in North America. Look at U.S. Spirits. It suffered a brutal 11.5% decline. According to management, this drop was almost entirely driven by softer consumer demand for Don Julio, Casamigos, and Crown Royal. Essentially, they had a major tequila and whiskey problem as inflation bit into wallets and consumers traded down or just drank less. Now, it wasn't all bad news. Their U.S. beer division grew 4.4%, and Canadian sales actually jumped 7.7%. But those bright spots were basically just a drop in the bucket compared to the massive hole left by premium spirits. And speaking of Canada, these high-level corporate shifts often have very real, highly publicized local consequences. In September 2025, Diageo announced it was closing its Crown Royal bottling plant in Amherstburg, Ontario, by February 2026, shifting operations to the U.S. and resulting in 180 local job losses. This sparked intense political backlash. Doug Ford, the Premier of Ontario, staged a press event, physically poured a bottle of Crown Royal onto the ground, called the corporate decision dumb as a bag of hammers, and vowed to retaliate via provincial purchasing. From the company's perspective, this was strictly a necessary supply chain optimization to protect margins. From the local stakeholders' perspective, it was a severe socioeconomic blow. If we zoom out, we can see how this all fits into a broader timeline of corporate transition. The turbulence wasn't just in retail stores. It was happening right inside the boardroom. In July 2025, CEO Deborah Crew resigned with immediate effect. After an interim period, Sir Dave Lewis was officially appointed as the new CEO in January 2026. He stepped in right as these difficult structural decisions, like that Ontario plant closure scheduled for February, were coming to a head. It's a rapid, dramatic sequence of events that paints a picture of a company urgently searching for stability. Which naturally brings us to our fourth and final section, the turnaround strategy. Sir Dave Lewis was brought in specifically to right the ship. So how exactly does a legacy behemoth reinvent itself? The crucial point here is that Lewis is fundamentally decentralizing the business model. His playbook has three main steps. First, he is breaking down this massive global footprint into 5 broader regions and 23 targeted clusters. The goal? Slice through corporate red tape and empower local teams to move faster. That leads to step 2, a renewed focus on total spirits, which notably includes going after the booming ready-to-drink market, alongside pushing premium beer like Guinness. Finally, step 3 is prioritizing customer partnerships. Lewis bluntly noted that the company had basically coasted for too long on the sheer strength of its brand names, and now they desperately need to step up their on-the-ground service and retail execution. But this strategy isn't just structural, it is heavily digital. Diageo is pouring an estimated $619 million into an information and communication technology transformation. They are aggressively expanding their e-commerce footprint through third-party platforms, think Drizzly in the US or Tmall in China, while simultaneously launching their own direct-to-consumer sites like thebar.com. By integrating artificial intelligence, big data, and robotic process automation into the supply chain, they're aiming to drastically lower operational costs. What does this mean for you, the consumer? It means they are trying to reach you faster, exactly where you're already shopping, and effectively cut out the traditional middlemen. Ultimately, though, leadership knows that you cannot separate corporate culture from business strategy. You can deploy all the AI and regional clusters you want, but it requires buy-in from their 27,500 employees. The new behavioral mandates coming straight from the top are crystal clear. One team, competitiveness, and decisiveness. They are demanding a faster, leaner, and frankly more aggressive approach to winning back market share, sending a loud signal that the era of resting on their historical laurels is officially over. Which leaves us with the ultimate question. We've seen the massive scale of their economic moat, the margin pressures they're facing in key markets like North America, and this ambitious, digitally driven turnaround strategy they've launched. The blueprint is certainly there. But can this centuries-old legacy business actually execute this modernization fast enough to win over a new, highly selective generation of consumers? The next few quarters of their financial filings are going to tell that story, and we will be watching closely. Thank you for joining me for this explainer, and keep learning.